There's a whole scare tactics game going on, and especially retail is very vulnerable there. So that happens, yes, but not in a way that it can suppress price forever, sort of thing. And also, just to give that some data, some underlying, it's if we look at the big price swings of Bitcoin, those were not caused by manipulation. You can easily attribute those to other things, like macroeconomic news, or the big down in the big drop in last year was caused by the Chinese mining ban, very explicitly, and the big drop in the year before that, in 2020, was in March. That was the COVID scare that was visible in all markets. The current drop, maybe from last 2 or 3 months, is caused by the inflation and the possibility of the rate hikes by the Fed, and the 10-year interest rates really going up from 1.5 to 1.8%. So, and even before that, I think you can attribute all the major drops to some macro or Bitcoin specific event, and not so much to manipulation. So it's Occam's law, basically, Occam's razor. The simple explanation is that's a macro or Bitcoin specific event, and not manipulation. And I know that especially since the end of 2017, when the futures market started for Bitcoin, since then there was talk about manipulation of the Bitcoin price, and that Bitcoin would never see 20,000 again, because now there is futures, blah 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 blah. But here we are at 40,000, and yeah, so we did see that 20,000 again, and from my point of view, as an ex-institutional investor, I should say, because I quit my job in March, as you probably know. But I see derivatives markets and futures is always the first, as a good thing, as a natural growing up of the market, as a maturing markets should have derivatives markets, because derivatives markets slice and dice the risk and return profile of the underlying asset, and make it more accessible to participants that would otherwise not invest in Bitcoin. For example, a lot of traditional finance institutions, say the ETFs that we now have, the futures ETFs, a lot of the funds are not equipped in their back offices to handle Bitcoin, to handle all the keys and the wallets and the processes that go with it, that not one asset manager can walk away with all the Bitcoins. That's what we have seen in some exchanges, of course, over the past couple of years. So they're very scared about handling the Bitcoins themselves, and they're very happy to pay a premium to not have to do that. The same thing with gold. So some gold investors rather have the paper than having to buy vaults and guard the vaults and insure all the gold in there. So there is a very large group, actually, of traditional finance people that rather have paper Bitcoin, and futures makes it possible to have exposure to the asset without having the asset. It costs you, of course, it costs you the difference between the spot price and the futures price, which at times can be very large, like 20 or 30%. Right now it's under 10, so it's normalized, if you will, as it should. So I always like the because futures markets are not something from the last couple of years, or even since we have computers. The Romans had future markets, and I always like that story, because it tells you why the futures markets do add value in the real economy. So it's not all paper trade, not all funny business. It adds real money. It adds real value to the real economy. The Romans had futures on olives. So the olive farmers had a big risk. They would spend all their money on the seeds and the land and all their work in growing the olives the whole year, and then there could be frost in the winter just before the harvest, and everything was gone. So that was a fairly significant, difficult to hedge risk for those farmers. If that happened in the particular region, the weather was bad and there was frost, then they defaulted. So the futures contract, then there were investors in olives, the buyers of the olives, that said, well, what I can do is I can give you 80 cents on the dollar of your future harvest, which is basically a futures contract, and I'll take the risk. So if there's nothing, well, then you have at least your 80%, and I have nothing. If there is an harvest, then I bought it 20% cheaper. But that's what I can offer, and that's how it went. And of course, the big investors could hedge themselves because they could future buy with these contracts olive harvests in the south of the country, the north of the country, other countries, and in that way hedge their exposure, because it wouldn't freeze in all countries together. And in that way, you made it possible for a lot more farmers to actually take the risk of investing all they had and working all year long, making the olives in the first place. So without futures markets, there would be less olives. And the same is true for a lot of the commodities, especially the soft commodities, like orange juice, oranges in Florida, and pork belly and all that. Well, all the markets that we see futures right now. So it really adds value to the economy, and so it also does in the Bitcoin market.